Good morning. You've tuned into ET Now. This is Buy Now Sell Now. I'm Karunya Rao, and with me is Varun Hirma.
Now, before we move any forward, let's quickly do a market check this morning. The top 5 stocks gaining and in the green are Tata Steel up nearly 5%. You have a Hindalco up 3%. You have an ICICI Bank up 3%. An HDFC up nearly 3%. And an NTPC up nearly 3%. So a mixture there, some metals, some banks, and then a PSU. On the losing side, you have a GAIL down nearly 1.5%, a Bajaj Auto as well nearly 1%, a Sun Pharma, an ONGC, and a Hindustan Unilever. So one from Pharma, one from FMCG, one from Auto. So the losers are kind of spread. If you look at the overall advances versus the declines, the Nifty 38 are in advance right now, while 28 are in decline. So that's quite positive. And just quickly on the indices, your mid-cap index is up over 1%, your auto index is up 1%, the bank index is up 1%, your mid-cap index is up nearly 1%. So we're trading firmly in the green this morning, Karunya.
All right, let's take it across to Vivek as well. MSCI Index weightage review is due today, so he's standing by to tell us what are the expectations from this time around. Which stocks should one be focusing at as well, Vivek?
Well, it could be an extremely important day as far as Indian equities are concerned. Now remember, what this particular decision has been deferred for quite some time. We are talking about the MSCI's decision to go ahead and increase the weightage of India in the emerging market index. Now, why would they go ahead and increase the weighting? Like we had discussed earlier quite a bit, the fact that the FII and FDI fungibility decision has been taken by the government has actually forced the MSCI to go ahead and consider or reconsider their decision to go ahead and increase the weighting as far as Indian equities are concerned. Now, some of the stocks that could be in focus on the back of this particular decision. Number one, you have to look at Kotak Mahindra Bank. Now, remember, the FI limit here has been hiked quite significantly. In case it is included, you could see a large amount of flows coming in as far as Kotak Mahindra Bank is concerned. Some of the other stocks that are likely to see weightage increase on the back of the MSCI decision. First on your list is the Colgate Palmolive, NTPC. Now watch out for NTPC. This particular stock could see flows anywhere in the range of 5 to 6 day, the average daily volume. Also names like Nestle, Divi's, Britannia, Container Corporation as well as L&T. All of these stocks are likely to see a weightage increase. Also, the one thing to keep in mind is that the MSCI may or may not take the decision today, but you expect some communication from the MSCI in terms of this particular quite a big decision as far as the entire Indian equity market is concerned.
All right, thanks for that, Vivek. Let's now switch gears. Both our guests are with us, Kunal Bothra as well as Mr. Chokalingam. Good morning to you both and welcome to the show. Kunal, let's come to you first. As always, really strong handover from the US markets, and that market just is ignoring any piece of negative information that's coming in right now. Our market seems to be following suit today. What's your read on the situation and anything particular that's standing out to you this morning?
So, yes, Varun, good morning first of all. I believe that the handover was quite good. The index is overall in a range. I indicated yesterday as well that we are trading now with one of the thinner OIs or open interest on the bank Nifty futures, and when you have such kind of a scenario, you're bound to get more moves on the indices, more volatility on the indices, but it may not result into any kind of a trend because there is hardly any there is lack of participation to be more precise. So I think in that regards, the markets would continue to meander in this 200 to 300 point band. 10,200 approximately could act as a support. 10,500 is where I believe the resistance is. So at least for the good part of this week, assuming there is nothing major which comes out in the announcement today, from the PM speech, then I believe that markets could remain more or less in this 300 point band on the Nifty. Now, in that regards, I believe that with the opportunity that stocks are seeing good rise, good market breadth. So I believe in that regards, I would initiate a couple of buy calls, and the two buy calls would be, the first one is about M&M, Mahindra & Mahindra. I think the stock looking extremely good. We discussed the stock even yesterday as well. I believe even at current levels, the stock looks quite strong for at least a 6 to 7% upside from current levels. Hence a buy on M&M with targets of 540. and stop loss to be kept at 480 mark. The second would be a buy on NAM India Nippon Asset Management. I think even this stock is looking quite strong. There's an inverse and shoulder pattern, more of a rounding bottom pattern as well, getting formed for NAM India as well. So I think in that regards, the stock is due for a very strong breakout. And looking at the way the markets have structured, mid cap stocks doing pretty well. I believe NAM India could also try and pick up pace from current levels. So buy, stop, targets to be kept at almost 330 and stop loss to be kept at 300.
All right, thanks for that, Kunal. G. Chokkalingam is also with us. Let's take it across to him. Good morning. What are your wealth creation bets?
Yeah, three stocks I would suggest. One is KSB Limited, earlier known as KSB Pumps. I like this because the stock has corrected a lot, and secondly, it depends quite heavily on the agriculture sector. We have seen agri sector is doing extremely well, and it is engaged in the pumps, and it has implemented a backward integration, and it is getting into nuclear pumps. And the stock MNC stock trades attractively at 18 times 1 year forward earning. So this stock I believe can give a target price of 580 rupees quite easily. The second, my old passionate stock, Cochin Shipyard. Again, I think the time is now relevant for the stock to play out because it is engaged in naval ships. We all know that there is some stress in terms of relationship with China, and these ships are used for monitoring the ocean, and there would be more and more demand for such ships because the suspicion has increased on both sides. And the company also came out with very good results. In tough time, it has posted 32% year-on-year profit growth, sitting on a cash little more than 50% of the market cap. The interim dividend itself, which is still it is trading come dividend, that itself is around 5% yield, and orders on hand will last for next 3 years. So all positive ingredients are there. It is down by 44% from 2-year high, and more than 30% from public issue price. So there is a lot of price comfort as well. The last one, Airtel, Bharti Airtel, this is from a defensive perspective, because I do expect market correction once again. In such a case, telecom company like Airtel can give a lot of cushion. I also strongly believe that like Reliance Jio, Airtel also would be able to attract quite a good amount of FDI in the medium to long term. So therefore, I would recommend strongly Bharti Airtel as well.
And Kunal, thank you for your picks. Let's now move forward with our queries. Query 1 coming in from Sagar Mehta. He has written that he wants to invest in HDFC Bank, and he wants to know things from a short-term standpoint. So Kunal, what do you think about HDFC from a short-term standpoint?
I think it looks attractive. I think HDFC Bank and large cap other banks, I think ICICI Bank, etc., they've been looking quite strong, in last few weeks and months. Even though they've not, gone back to their prime behavior, what they used to see, I think, in entire 2018, 19, or start of 2020 as well. But nevertheless, I think they're trying to make a good comeback. So maybe the news flow around these stocks improves, then you can see a material improvement in the stock price trends as well. But of late, I think in the last 2-3 days, for example, HDFC Bank has given a minor kind of a swing breakout. Now the problem with these swing breakouts in the market is that there is no follow through which happens. So what you have to do is you just have to try and ride it with patience, and maybe the stock provides any kinds of dips on opportunities. Then I believe take that as an opportunity to average further. So I think if you've invested into HDFC Bank, then you can stay put there. And if you're looking to buy, then I believe starting from current levels and maybe the stock provides any sort of minor dips, take that as opportunities to buy.
Chokkalingam, I'll come to you for HDFC Bank as well. Firstly, should one even be looking at such a high quality name for short term? What will be your advice to Sagar?
Short term one can do trading in HDFC Bank because I expect a market correction, and last 2.5 months we have seen several times even HDFC Bank could correct 5 to 10%. However, for long term I am quite bullish on HDFC Bank. Even in the short term the business is growing, banking business at a 6% annual basis, and to HDFC Bank being a leader in the private sector would be able to survive the ongoing crisis. So certainly it's a hold for long term. If he's on a profit, he can do trading in the short term, because I would expect a lot of volatility in the HDFC Bank as well as in the whole market in the next 30 days to 45 days.
Okay, let's quickly address steel strips flash as well coming on the screen. They're looking to induct an investor to lower their long-term debt. That's something that we're picking up from agencies right now. Steel strips is important to watch out for in trade as well. They're a auto ancillary company and they do attract a lot of traction as far as the markets are concerned. Steel strips definitely continues to be in focus. Okay, moving on from HDFC Bank then to another query. PS Jain has written to us. He's bought 100 shares of Maruti at 4,011 rupees and he's a long-term investor and wants to know what our experts think about this. Kunal, coming to you on Maruti, yes, the stock is now giving him good returns, but over the slightly longer term, do you think it perhaps has the potential to come back and crawl back to those 8,000-9,000 levels anytime over the next 1-2 years or more?
Well, I think there's a fair possibility, and I think congratulations to the investor. I think he's bought at almost the exact low with the stock had hit on the March and the April month. So I think in that regards, I think it's a phenomenal buy price for the investor, and I think that's where the investor probably or the viewer has cushion, because he's bought it at such a lower rate, and the stock is now at 5,700. So you already have a cushion of more than 30-40% in your stock price purchase. So I think in that regards, I believe you can hold on to it. Now I think it all depends on how the auto sector theme overall evolves. See, you've seen a lot of strength coming by into many individual auto space, and specifically for two-wheelers, you have Bajaj Auto, Hero MotoCorp, which have done exceptionally well. Then you have the tractor stocks like M&M, Escorts as well, which have done exceptionally well. So maybe I think in a matter of a few months or a couple of quarters, you might see even the passenger vehicles or the ones like Maruti, etc. They could also try and pick up pace. So I think in that regard, since you bought it at a good price, you have a lot of buffer, and you are investing into a large cap name, I would sense that you should definitely hold on to your investments on Maruti.
It's quite positive on Maruti. Mr. Chokalingam, how are you reading into Maruti right now?
If he's a long-term investor and doesn't mind 10-15% fall, he can hold on to it. Otherwise, I would prefer to sell it and buy on more than 10% fall, which I anticipate. I am terribly negative on auto sector. The wealth is not created any asset class except in the stock market in the last 2 months. Job losses are there, business incomes are going down. It's going to be very tough for automobile sector, at least for next 6 months to 10 months. I think there is a lot more pain still left for the auto sector, and I see 10-15% correction in the short term. So I would suggest sell and buy if it falls more than 10%. But if you don't mind such a short-term fall, then you can hold on to it, because in next 1 to 2 years, Maruti will come back with a growth path and it will retain the leadership position.
Thanks for that, Mr. Chokalingam. So also quite positive on it from a long-term standpoint. With that, I think we're done with our queries. So time to say goodbye to both our guests. Thank you so much for taking out the time to share your opinions with us as always. But let's move forward. We spoke to Saurabh Mukherjee, the founder of Marcellus Investment Managers, and asked him about the world's dependency on Chinese APIs. Let's listen to him to know more.
I think this the place where we're very, very keen to do more work is just that it is a complex sector. Is what we are hearing from pharma experts in America and buyers in America is that the sheer scale of the Chinese API market is such that there is a clear desire on the part of global pharma companies to reduce their dependence on Chinese APIs. So even if 5% of the Chinese API production moves to India, India's API demand doubles, API production doubles. India's API production doubles, which is 5% of the Chinese market migrates to India. Now, if India's API production doubles, there's a whole kind of supply chain of chemical intermediates, down to raw chemicals, then glass line vessels, right? There's a whole ecosystem there, right? That we would love to understand in more detail. And a lot of these are listed companies, small cap, mid cap listed companies. The chemistry is a little complex, and unfortunately, not that many of us in the team have chemical engineering degrees. So there's a little bit of chemical complexity. But the other thing is this is a completely new world, right? Our API sector has actually shrunk in the last 20 years. So to potentially look forward to the doubling of API production in India over 3, 4, 5 years is something very exciting. And my reading is there will be plenty of money to be made here. Just a question of doing some diligent research on not just the straightforward part. The straightforward part is Divi's lab makes API and they grow. That's easy. But who supplies Divi's lab? What are the intermediate suppliers? What are the machinery suppliers to the sector? And I think there's potentially a whole ecosystem that will blossom there as the world reduces its dependence on Chinese API production.
Welcome back. You're still watching Buy Now, Sell Now. Let's get you some updates with respect to the pandemic as well. Global cases have topped the 10.2 million mark. It's 10.2 crore mark. Cases in India have jumped to 5.66 lakhs ahead of Unlock 2.0 PM to address the nation today. MHA has released guidelines for Unlock 2.0. Bar on cinema halls, international flights to continue. India's first vaccine, Bharat Biotech gets nod for that. BMC meanwhile asks private hospitals to ensure staff check. Some warning being issued by the WHO in the meantime, saying that the worst is yet to come. UK PM promises New Deal to rebuild economy. And lastly, Merkel and Macron to unite on EU recovery.
Well, 2020 sure has been a roller coaster ride. It's the end of the month, end of the quarter, and end of the half year as well. How have the markets fared so far? Local versus global markets in June? Let's listen in to Jayesh for more.
It's been a good month and quarter so far for the Nifty itself, but not so much as far as the year so far has been concerned. If you have a look at the Nifty versus the Dow Jones, you can see that from the table that is highlighted on the screen that for the month and the quarter we have managed to outperform the Dow Jones index. However, we have underperformed on a year-to-date basis. But let's move on and look at how the month of June has fared. Well, it's all been about the broader market indices as well as the PSU banking stocks, which have gained as much as 30% in trade for this month itself and double-digit return for the broader market indices as well. However, the frontline indices, which is the auto, metal, IT, pharma as well as FMCG index, those have managed to underperform for the month itself. And if you have a look at the quarterly performance, this entire chart actually reverses with the pharma and auto space leading the way, more than 40% return for this month itself. And you have the FMCG, PSU bank as well as the banking index, which has underperformed a tad bit. Also, the year so far, has not been encouraging because you have only the Nifty Pharma index that has given you positive return. More than 25% is what we are referring to. The Nifty FMCG index has been largely flat, but it is really the PSU banking and the banking space which has taken a knock of more than 30 to 40% as far as these indices are concerned. And you have the mid cap and small cap index, which have also declined more than double digit for this year itself.
Thanks, Jayesh, for that update. Pankaj is standing by for an important story. We learned from our sources that Bharti Airtel's wholly owned subsidiary NXTRA Data is looking to raise 200 million from the Carlyle Group, where Carlyle might pick up 20% stake at $1 billion valuation. Pankaj, can you fill us in with more details?
So, NXTRA Data, which of course is a subsidiary of Bharti Airtel, Carlyle is looking to pick up about a 20% stake is what we are picking up from sources. This could be about $200 million odd dollars, which means they are valuing the company at about $1 billion. It's one of the largest data centers, cloud management services that Bharti operates, and it's an arm. It's a 100% self-owned arm, which helps in data management services. This is something which Carlyle is evaluating, but what I'm picking up from my sources is that the deal is in advanced stages and the announcement could come in pretty soon. We also tried to contact the company for a comment, but at this point of time, we have not received any sort of communication from them, or we are still awaiting the reply from the company. Overall, the deal announcement could happen anytime soon. Overall, Carlyle may pick up 20% stake for about $200 million in NXTRA Data, which is a subsidiary of Bharti Airtel, and they do the data management services as the data center services as well as cloud management services.
All right, thanks for that, Pankaj. The deal sizes are much smaller, obviously, than what we saw in Reliance. But it's interesting to see that Airtel is now also, in some small way, trying to, figure out the data part of the telecom game, not just the regular business. So that'll be an interesting one, and the counter is fairly active today. But let's switch gears. My colleague Mobina earlier caught up with T.V. Narendran, CEO and MD of Tata Steel, regarding the COVID performance and obviously the Q4 COVID impact. Let's listen in.
I think in India, we have started seeing an improvement in activity from November, December till COVID hit us in March, right? So I think the momentum was picking up, and we did see price increases in January and February and going up to March. So it's unfortunate that we had to deal with the pandemic at this point in time. As far as imports is concerned, to be very honest, China has not been a big issue for the last year or so. I think the biggest problem we had from China was in 2015-16. Subsequently, I think our challenge has been more with steel coming from countries with whom we signed FTA, primarily Korea. So Japan and Korea have been a bigger issue for us than China over the last couple of years. We were a bit concerned about the impact of Chinese exports post-COVID in China, because China had slowed down in January and February, and hence we were a bit concerned whether we would be flooded with imports from China. But, surprisingly, the demand picked up very fast in China. And as you just mentioned, not only is China exporting less, in fact, China is exporting only about 4.5 million tons a month now, but China is also importing steel. And the Indian steel industry is, I think, now exporting close to 1 million tons a year, 1 million tons a month into the export markets, and most of it is going into China, or at least more than 50% is going into China. So the Chinese steel consumption, the demand pickup post the pandemic has actually helped the supply-demand balance in the Asian markets. As far as India is concerned, where we are seeing positive activities in the rural markets, so directly and indirectly, whatever is going into the rural markets is helping us. So if you look at it directly, roofing sheets, the market is strong. The rebars that we sell into the rural markets to the individual house builder is going well. Any product which is sold in rural markets like tractors, we're seeing tractors being sold at the levels that we saw pre-COVID. Motorcycle demand is slightly better than scooter demand, because motorcycle is primarily a rural market-driven business. So there are many areas where we're seeing activity pick up in rural markets. Also, the government's announcement on expenditure in infrastructure in rural markets is positive. So we believe rural India will recover faster than urban India. I think there is a lot more labor available there. There's a good monsoon and a good harvest as well. So for multiple reasons, we are more bullish about the rural markets. And as the labor starts coming back to the urban markets, we expect construction activity to pick up. And if the government continues to focus on infrastructure, I think that's positive. So we are actually quite positive about Q2. I think, as we mentioned, we were at about 80% production levels in May and June. But I think towards the end of June, we are going to be running at 100%, and we expect the next quarter will be running at 100% in all our main units.
Okay, let's move right on to the world of tech and startups. Is this the demonetization for Indian social apps? Naveen Tiwari, the founder and CEO of tech unicorn Inmobi, said the government's move to ban 59 Chinese apps is historic and it will make India globally, or rather digitally, Aatmanirbhar. Inmobi, which owns two consumer platforms, Glance and Roposo, says Roposo has grown 10x in the last few weeks as more Indians have uninstalled Chinese apps. Here are this exclusive conversation they had with my colleague Chandra Srikanth.
First of all, as an entrepreneur in India, I think this is a way for India to be digitally Aatmanirbhar. This is historic because, digital companies don't necessarily have boundaries just by the nature of what the internet is. And in India, given the population and given how digitally savvy the population is, I think it was important for India to essentially control its own data, control and take care of its own security, and therefore making India a digitally Aatmanirbhar country. It's a great, phenomenal move by the Honorable Prime Minister. And yes, you are right. Inmobi owns Roposo, and it's a great thing. We are very proud of having created two consumer platforms. One is Glance, another is Roposo, as part of Inmobi Group. So feel it's a matter of great pride for us to essentially be having two made in India consumer platforms being the two largest platforms in the country today.
Naveen, in the last few weeks, we've seen a lot of chatter around Roposo. It's almost been a trending topic of sorts on Twitter. A lot of call to boycott TikTok and encourage people to get on Roposo and Chingari and Metro and all these apps. So what kind of traction have you seen tonight once the government came out and said, you know what, starting today, these 59 apps are going to be blocked or are going to be banned?
You're right. Over the last 4 to 6 weeks, the Roposo in itself has grown almost 10 times in scale, and it's phenomenal how the passion and the emotion within the country was running. It was truly to see Desh Bhakti at its peak for the last 4 to 6 weeks. In the last hour or so, I think we are seeing a rocket ship go up right now. We all of our engineering teams are up right now, just monitoring and trying to make sure as they welcome whole of India on Roposo and Glance, they're able to do so in a manner in which they find this seamless. And so I think we'll do a good job of welcoming India onto their own entertainment platform called Roposo, and that's what our team is focused on.
Naveen, there are two ways to look at it. One section believes that when China doesn't have any qualms in banning whatever apps it sees fit, it's only fair for India to do the same. But the other view is that shouldn't we consider users who have been on these platforms? TikTok has been a way for many people in tier 2 cities, tier 3 cities in India, a platform for expression, to even make money. How do you see this from a user perspective? Is it fair for the government to unilaterally clamp down on usage on apps, a big brother kind of move?
I have a very simple view on this. I think what the government has done is not essentially take, let me put it this way. From a user perspective, if you think about this, I think if the governments would come in and just start removing platforms if the users are on it, I don't think that's what our government does. And there's no history of it also, by the way.
Hello and welcome back to Buy Now, Sell Now. We have Sanjay Bal, Group CFO of Raymond Limited, now with us. Good afternoon, sir, and welcome to the show. let's begin with, the Q4 performance was a bit subdued, we're guessing due to the lockdown. The quarter saw EBITDA loss. So what are you doing to turn around the operating performance, and how are you rationalizing your costs? Also, by when do you see demand recovering?
Yeah, sure. I think if you look at the quarter four results, largely they've been impacted by two big events, really. One, which was the impact of COVID-19 on businesses. The entire lockdown has been unprecedented, and resulting in a complete shutdown of our operating stores and plants. But even before the shutdown actually happened in the third week of March, what is important to note is that the trade channels had stopped and slowed down their procurement and purchases because everybody was anticipating, watching the global situation. So the consumption slowdown had already happened. So the impact in March has been quite substantial. Against a potential sale of about 630 crores, we ended up at about 247. So that's the kind of drop that we saw in all across our businesses. So a 414 crore drop in revenue translated straight to the bottom line because at gross margin level, it impacted the EBITDA, and we had a 134 crore impact on EBITDA because of this. So that's the big swing that has happened in this quarter. In the immediate short term, there's very little that can be done about the costs, and there's very little reaction time apart from cutting the obvious.
All right. And, so in terms of operations, what's the current status of your manufacturing facilities, and how many of your stores are operational, and what kind of footfall are you seeing in the stores?
Yeah, so our stores started opening up from May. The advantage that we have is that we are spread out from the metros to the tier 6 towns. So we have a very large footprint across 634 cities. So we saw opening up of stores from the first half of May onwards in the smaller towns. And gradually this kept on improving day by day. As we speak today, about 85% of our stores are open across metros to tier 6 towns. So we have a total of about 1632 stores. 85% of these stores are open. And if I bracket them into the tier 1 and tier 2 as one bracket, we have about 75% of our stores open in this category, and the tier 3 to tier 6, where 65% of our stores are there, the stores which are open are about 95%. So business has been coming back. We've seen consumption levels started at about 30% of pre-COVID levels. Today they are hovering at about 45 to 50%. So there has been improvement. There has been some demand which is there, pent-up demand which has been there. There is a marriage season which ends in July. So there has been some buying because of that. There are encouraging signs. Customers are coming back to stores for very.
Mr. Bal, hi. Just want to understand on the retail front as well. Now that the lockdown is easing, tier 2 and tier 3 cities, especially which are relatively less affected by the pandemic, how has the demand been in these areas? Are you witnessing a pickup?
So because of our presence there, we can clearly see the differences that are visible. So in the tier 3 to tier 6 towns, we have seen encouraging footfalls there. There is demand, that there is less apprehension in the minds of the customers as well in terms of coming out to the shops to buy. Clearly there is a reason to buy, and because we fulfill a certain section of the demand in terms of meeting the requirements for the marriage season. Clearly there is we see customers coming in clearly to service that need. Rural areas as well, we have seen better footfalls. The percentages have gone in some stores as high as 65 to 70% of pre-COVID levels as well. In the metro areas, the store openings are also lesser. Also, there are a lot of restrictions which are there. There are days on which the stores are odd days where the stores are open, then even days where the stores are closed. So there is also uncertainty there, and that is also impacting sales in the metro areas because there are regulatory constraints in the urban areas is much more than it is in the rural areas. So clearly, that is also resulting in an impact on consumption. But clearly, encouraging signs in the rural areas for sure.
There's a lot of global demand coming in for masks, for PPE kits as well. You forayed in the segment and as well. You've been manufacturing PPE kits. Can you tell us how that is shaping up for you now that the government has also lifted ban on exports? Are you expecting more orders from abroad?
So we were very quick to pivot onto this opportunity. Given the distribution strength that we have, I mean, we are present in antiviral fabrics. We've got an FMCG division which has launched a range of sanitizers and floor cleaners on hygiene products, and of course we had a garmenting plant which started manufacturing the PP overalls and coveralls. So we have a full portfolio of products which we can offer, and we've created quickly a new division called Raymond Care, and within that we are looking at meeting the institutional needs and also the needs of the hospital and the healthcare industry in terms of servicing their requirements, and a lot of work has already been done there. In terms of export, clearly yes, the opportunity is there. But as of now, there is less clarity in terms of what is allowed, and we will wait for, I think, the next week or 10 days to see whether we are allowed to export there. There is a restriction which is still there in terms of the total exports that can be done. But we are geared up to meet the export requirements. There is also a domestic requirement which is strong. The advantage that we have is that consistency of quality that we can offer. There are a lot of smaller players who have also come up to seize this opportunity. But the key differentiator here is going to be the quality of the product, and I think that's where we will have an edge.
All right, thanks for that, sir. And finally, from us this morning, before we let you go, if we could look at the big picture, there's a potential shift in business out of China. So have you seen any new inquiries from existing or new clients as a result of this?
I think that's a huge opportunity that we also see. In terms of the global businesses pivoting their supply chains away from China or looking at alternatives. India does offer a substantial solutions to businesses globally. China is the largest player and supplier to businesses globally. They have a total portfolio of $90 billion in terms of supplies globally in the garmenting business. And India is much lesser, and clearly we see the opportunity there. In terms of our own customer base, we do see inquiries coming in. We offer a lot of solutions to our customers, and given our relationship, we want to leverage that. There are early signs of that already happening, but clearly what we would expect from the government to do, and we made our representations, is to enter into trade pacts now. This is something that Vietnam and Bangladesh have done extremely well. They have entered into bilateral trade pacts with countries. They have the advantages of export subsidies, and benefits and custom duty, remissions. And we would seek that for India as well. This is a big opportunity unfolding in front of us. And the anti-China sentiment is there globally as well. Within the country, in the domestic consumption, also there are positives that are there for the business. China was one of the largest suppliers of unbranded textile fabric, both polywool and polyviscose, and clearly that they were dumping dumping it into the market because of the export subsidies that they were getting from their government. And clearly we have made representations. It's time now to take action. The trade sentiment is against China as well. And we hope that this really results in some concerted action on preventing dumping from China.
All right, thanks for joining us this morning, Mr. Bal. On that note, I think we let you go. That was the management at Raymond after their Q4 numbers. Let's switch gears a little bit to the Power Ministry. Power Minister Archie Singh has told ET now that the new tariff policy could get the Cabinet's nod as early as this week. He is confident that the demand for power will gradually revive as the economy moves towards greater unlocking. And as the demand revives, he is encouraging power players to support the Make in India drive. Hear him out in conversation with my colleague Ruchi Bhatia, who began by asking him about the Aatmanirbhar Bharat mission.
I would like to begin by saying that if Aatmanirbhar Bharat is important for all ministries and departments and all sectors, I think it is the most important for our sector. And the reason for this is that power is a strategic sector, it is a sensitive sector. It is power which, enables all our industries to run, including defense industry. It powers all our communications, it powers all our databases. So most developed countries have declared power to be a strategic and sensitive sector. Coupled with that, this is a sector which is also vulnerable to cyber attacks, very vulnerable to cyber attacks because of the large networks. So from that point of view also, apart from the point of view of creating jobs here, from the point of view of security and from the strategic perspective, Aatmanirbhar Bharat is absolutely important for us. Now, as far as the conventional power is concerned, we make almost everything here. So actually, there should be very little need for imports, except for some very high niche technology items like HVDC, etc. But the surprising thing is that despite the fact that we have manufacturing capacity in almost all segments of the conventional power sector, generation, transmission, distribution. Despite that, in 1819, the imports were about 71,000 crores.
All right, before we wrap it up right here on Buy Now, Sell Now, here's an important excerpt that we've got you from the Money Show. It's about coding, which will be a skill everybody will need to learn for the class of 2020. Looking for a job, consider taking whatever you get right now and discover your dream job a bit later. Here are excerpts from day one of TMS's Personal Finance Unlocked session by Swati Salunke and Rituparna Chakrabarti of Team Lease.
The industries which are most vulnerable, or companies which are most vulnerable, are the ones who have a not so favorable cash flow situation. I mean, any organization which is a heavy cash burner will stand exposed. Organizations which has high net debt. I mean, companies that have borrowed money relative to their earning are likely to be worst affected, and are, honestly. Even cost structures. Companies which have very heavy fixed cost structures are likely to be most exposed. Any people-intensive business. I mean, it's an anthropological cataclysm that we're witnessing, and hence people-dependent businesses are likely to be hurt.
But everything does not have to be doom and gloom. Of course, COVID-19 may give rise to different kinds of jobs, different kind of industries as well out there. So Rituparna, are you seeing a resurgence in hiring in any sector, any industry, or let's not talk broad base, but even in any particular skill, any particular job that industries want, that the world wants?
Yes. If you allow me to be granular, I'll try and be as specific as possible, because I know this is something that everybody wants to know about. Is there a silver lining? And if yes, where in the current situation? But before that, a disclaimer. It's not that there is a huge resurgence in hiring, because I cannot paint that rosy picture.
Now that we have a plethora of tools as well available online, and that to very reasonable and competitive prices as well, what do you recommend? What are the skills that will be required tomorrow, or which would match some of the professions, some of the industries that Rituparna has recommended?
There has been a situation wherein certain skill set are going to be required. That is the need of the hour. And when we say that a little bit of jobs are changing, or the way the jobs will be done, definitely students or people have to now get geared up that there will be a different workplace by itself. Whatever traditional offices that we had, now it will be a my space, that is home space will come into picture a lot. Maybe something which will be more online. So brushing up with online technology is a must. Gone are the days when only a little bit of Microsoft Word or PowerPoint was enough, but now with the work from home, a lot of protocols and security issues will be there. There will be something as cyber security. So people, or the class of 2020 for that matter, and even the existing professionals need to understand that their work area has changed, and with most of the companies now declaring that work from home will be a very dominant factor. Even for that matter, our education system, we are going to have hybrid systems. So embracing technology is the need of the hour now.